J. Demonstrate understanding of the dividend payment process for common and preferred stock. The dividend process includes 4 key dates: declaration date, ex-dividend date, record date, and payment date. The board formally declares the dividend, establishing the legal obligation to pay. Preferred stockholders typically receive fixed dividends before common shareholders. If preferred shares are cumulative, unpaid dividends accumulate and must be paid before common dividends. Common dividends are discretionary. They depend on profitability, cash flow, and board approval that on the ex-dividend date, the stock price typically declines by approximately the dividend amount. Understanding the dividend process is important for investors assessing income timing and valuation effects. K. Define share repurchase and explain why a company repurchases stock. A share repurchase, stock buyback, occurs when a company buys its own shares from the market. Repurchase shares are either retired or held as treasury stock. Buybacks reduce shares outstanding, potentially increasing earnings per share (EPS). This may enhance financial ratios and market valuation. Companies repurchase shares to return excess cash to shareholders. It offers flexibility compared to committing to regular dividends. Repurchases may signal management's belief that the stock is undervalued. However, excessive buybacks may increase financial risk if funded by debt or reduce liquidity. L. Define insider trading and explain why it is illegal. Insider trading involves buying or selling securities based on material, non-public information. Insiders may include executives, employees, or others with privileged access to confidential information. It is illegal because it creates unfair advantages in financial markets. It undermines investor confidence and violates principles of transparency and equal access to information. Material information is any information that could influence an investor's decision. Examples include earnings announcements, mergers, or regulatory actions. Regulators enforce insider trading laws to maintain market integrity. Strong governance and ethical standards are essential to prevent such misconduct. M. Identify advantages and disadvantages of debt financing versus equity financing. Debt financing provides tax benefits because interest payments are deductible. It allows owners to retain control without diluting ownership. However, debt increases financial risk and requires fixed payments regardless of profitability. Excessive leverage may increase bankruptcy risk. Equity financing does not require fixed payments and reduces financial distress risk. It strengthens the balance sheet and improves solvency ratios. However, issuing equity dilutes ownership and may reduce earnings per share. Dividends are not tax-deductible. An optimal capital structure balances cost, risk, control, and flexibility considerations.